Hello, everyone, and welcome to Premia's V3 LitePaper presentation. Today we're going to be talking exclusively about the newest upgrade to the protocol that's planned to be released in 2023. The goal of this presentation is essentially to provide the listener with a primer to how the protocol works, the mechanics, and how a user would interact with the protocol itself. Hopefully, by the end of this presentation, we'll have accomplished those goals. We won't cover every single topic, but this is a great place to start if you are not familiar with the V3 design. So, our table of contents, things we're going to touch on today. As mentioned, this is just the LitePaper presentation. This is essentially an easier and more digestible form of the actual white paper itself. We're going to go through the protocol mechanics, how the protocol works, how the pools work, and basically a 101 or a how-to presentation on how to interact with the pools themselves. So, covered topics. As I mentioned, pools are going to be the focus of this presentation and how to interact with these actual pools. In the ecosystem, though, in V3, there are other components, such as vaults and RFQ system, as well as a margin module as well. Those are not going to be covered in this call. Hopefully, we'll create some additional presentations that will touch into these topics more specifically at a later time. And just for some housekeeping, just want to get this out of the way. Premia is not a financial advisory firm, and the contents of these videos do not represent any financial advice or investment recommendations. Decentralized finance is largely unregulated and entails additional consumer risks. Users must do their own research, and the risk of loss in trading option contracts can be substantial. So now that that's out of the way, we'll start with the prerequisites, things that'll make this presentation more easy to digest. Hopefully these are things that you already understand or know very well. The first will be options. That's hopefully is a little obvious. What a vanilla option is, the fundamentals of how options work, the difference between an option holder and an option underwriter, the differences between the European and American option, and just generally how option premiums are generated, how they're priced, where that price comes from, things of that nature. From a more specific blockchain perspective, having a good understanding of DeFi and just the Ethereum blockchain is going to be extremely helpful because we are EVM based. Having some familiarity with AMM designs and structures is also very useful. If you're a trader, you're probably already familiar with limit order books on centralized exchanges. That's probably one of the most common order book types that are available to users. Having some understanding of how that works is also going to be extremely helpful. Might seem a little confusing right now, but it'll make sense to you later in the presentation. Having an understanding of concentrated liquidity. So this is an important topic. Concentrated liquidity is a characteristic of our pool design. And so if you have ever interacted with Uniswap V3, for example, concentrated liquidity hopefully will make a lot of sense to you. One of the things that we try to tell people when we first start with giving them a framework and a mindset to look at our protocol or the V3 protocol is we try to tell them, if you understand how Uniswap V3 works, you can imagine that we are the options for Uniswap V3 design. So if you kind of mentally think of it in that perspective, you're probably already at about 50% of the way there in terms of understanding how the protocol works. There's clearly some differences between how we do things and how they do things, but those are the stuff we're going to get into in the presentation. So this is taken from the white paper. It's just a very simple one-line sentence of what is the protocol. So Premia V3 is a non-custodial options settlement engine and an automated market maker implemented for the Ethereum Virtual Machine. So hopefully that made sense to a lot of people. If it didn't, basically just means we do not hold your funds. We ensure that there is no counterparty risk when two people are interacting with each other. And we're designed in the structure of an AMM within Ethereum and Ethereum compatible blockchains. So we'll start with pool architecture and what a pool is in the first place. So a single pool represents a strike, an expiration, and an option type. And so as an example, if we took Ethereum and the code asset being USDC, if the expiration was March, the strike was 1200, and the option type was a call, this would represent one pool. As well as if it was a 1300 strike, that would represent another pool. Or if it was a put, that would represent also another pool, etc. These options are European in nature by design. If you're familiar with Premia V2, this will be a slight change. I believe the options in Premia V2 are American, whereas we've decided to shift to more a European structure. There's quite a few reasons for this. The primary one being the way we do our accounting system has changed significantly, and so it's much easier to manage European options than American. And just generally speaking, European options are the more popular type of option style in the marketplace. And so that makes our product more composable with other markets as well. So people who provide liquidity to this pool are considered a liquidity provider, otherwise known as an LP. So I will just kind of, for simplicity's sake, just call them LPs in the presentation. When we're trying to deposit capital or assets into these pools, we have to know what the collateral type is for each pool. So for all calls, the collateral asset is just the underlying. So using our example with ETH USDC, the underlying asset is ETH. And so for calls, you would have to deposit ETH into the pools. For puts, it would be the quote asset. And so again, in this example of ETH USDC, USDC would be the quote asset, and that would be the collateral that you have to deposit into the pool. The pricing of these pools is also based on the collateral asset. And so when we price a call option, in this example, we would price it in ETH terms. And when we quote or price a put option, we would do this in USDC. The base layer of the exchange is fully collateralized. So there is no insolvency risk or anything of that nature. We are not an under-collateralized or partially collateralized exchange system. If people are not familiar what that means, just very quickly, if you want to buy options, you have to pay the full premium amount. If you want to sell options, you would have to, for example, if you want to sell calls, you would have to provide at least 1 ETH of collateral for every ETH call option that you sell. And for every put that you sell, you would have to provide the USD equivalent of the strike price. So again, in our example, if it's a 1200 put option, you would have to provide 1200 USDC to be able to short that put. So the pool market structure. We are sort of a hybrid between limit order book characteristics and AMM characteristics. In our system, we use range orders, so also known as concentrated liquidity. And so that is an AMM structure, but we'll kind of go through now the the concepts that are very similar to order books and the concepts that are very similar to AMMs. From the order book side, we have market-driven liquidity, and our pricing is linear. So in a lot of AMM structures, they use non-linear pricing. That is a difference between our system, and that is generally considered a limit order book design versus a pool design. So something to keep in mind. Range orders can be initialized as either bid liquidity or ask liquidity. And we'll go into this a little further in the presentation. But essentially, you can think of it just similar to an order book, that there's bid liquidity and ask liquidity, and we do something very similar to that nature. LPs can also set the market price with their deposits. And so you can imagine like a limit order book, when there's a very wide spread and the market's not competitive, orders can be placed in front of each other that would essentially create more competition, and with more competition, the spread between the bid-ask collapses and gets smaller. That characteristic also holds true with these pools. When users or LPs put in capital, they can essentially cause the spread in the market to get smaller and smaller. Also, like limit order books, you can use a single asset for depositing. So, for example, if I wanted to get long an option, or I wanted to get short an option, I would only need to deposit the collateral asset for that corresponding option type. If I wanted to close a position, I could deposit that position into my LP range. So I could either deposit long options or I can deposit short options. Now, on the flip side, with AMMs, one characteristic that AMMs have is that they flip their liquidity. And so what I mean by that is when a price traverses through a range, that bid liquidity becomes ask liquidity, or vice versa. And so that's different than an order book. In an order book, once an order gets filled, it's taken and removed off of the order book. That's not the case with our design. Your liquidity will stay there. So if you did want to establish a single directional position, you would then have to remove your liquidity from the pool to keep that position or guarantee that you would have that position. Execution is done pro rata. This is different than order books. Order books is more of a race to be in front of each other, to execute faster than each other. That is not the case in our system. So if an LP comes in and puts a range order, and another LP comes in, say later, after this deposit happened, puts in the same exact order specs, same deposit amount, same range, they would both execute together at the same time pro rata. Whereas in a limit order book, that would not be the case. The person who came in second would execute last. So who initializes these pools? Well, it's permissionless by nature. There is an asterisk here, so we will go into that in a second. But generally speaking, it's up to the public to decide what it is that they want to trade. What we do have are guardrails, essentially, ways to sort of incentivize options that would be considered popular or more in demand. This is to help sort of drive and funnel liquidity to certain markets without having to hard code anything specific. To initialize a pool, there is a fee. That fee in itself, just as a overgeneralization here, the fee increases as a function of days to expiration. So all things being equal, the further out an option is in terms of expiration, the more expensive it will be to initialize that pool. In terms of moneyness, if an option is at the money, it's at its cheapest price in terms of initializing. And the further away an option is from at the money, the more expensive it becomes to initialize that pool. Just as an example, if we were to initialize a 50 delta option with a 14-day expiration, it would be roughly around $25 to do so. So we talked about permissionless with an asterisk. So The asterisks are these three components, which is strike intervals, expiration time or date, and oracles, right? So for strikes, we want to limit strikes to obvious strike intervals, ones that would make common sense. We don't want people creating all sorts of strikes and fragmenting liquidity unnecessarily. So we've algorithmically have a system that limits the intervals given the price of the underlying market. And so in this case, just as an example, for ETH, if ETH were trading at 1,500, the strike intervals that would be allowed are $100 intervals. So in this case, someone could create a 1,500 strike, a 1,600 strike, 1,700 strike, etc. In terms of expiration, the max expiration is 365 days. The expiration timestamp centers around 8 a.m. UTC Fridays. So there's an asterisk on this as well. Most options will be 8 a.m. UTC Fridays, but as liquidity increases and people decide that they want to trade 1-day options, 2-day, 3-day options, they will expire on non-Fridays, but it will still be at an 8 a.m. UTC timestamp. So for general practical purposes, most options that people are going to be trading will be on a Friday 8 a.m. UTC window. And this is also the requirement for initializing the pool. Obviously, with options, we also need an oracle for the spot market because we need to know what the price is at the time of expiration. And so that requirement should be obvious to most people. We will have a list of all oracles that would be approved in terms of being able to initialize markets. And so if someone wanted to initialize a new market and there was an approved oracle for that particular spot market, someone would be able to do so. So we haven't really gone too much into range orders, but we're going to start working into that right now. The first thing to think of is the word tick or tick precision. Ticks more specifically define range order price precision. And so what we mean by that is I have an upper and a lower bound on my range order in terms of prices that I'm willing to put my range order in. The granularity or the control I have in terms of what those price points are is the tick precision. The tick precision for calls is 1 divided by 10,000. So in other words, 10 to the minus 4, right? 4 decimal places of precision. For puts, it would depend on the strike. And so in this particular case, let's just say that we have a 1,500 strike ETH put option. The put precision would be 0.15. And so at first that might seem a little odd to someone. Well, why are calls 4 decimal places out and why are puts just 0.15 in this particular example? One thing to keep in mind is that calls are priced in the underlying and puts are priced in the quote asset. So in this particular case, the puts are priced at, or the tick intervals are 15-cent intervals. For calls, if you take 0.0001 times the price of ETH, it actually equals 15 cents in this example. And so the intervals normalized to dollars are actually exactly the same. That's not the case for all strikes, but they will be relatively close to each other. So finally, we'll get into these range orders that we keep talking about. So a range order basically consists of 3 parts, right? You have a lower tick, you have an upper tick, and you have a quantity. You could also call it liquidity. The liquidity or quantity can be either derived from collateral or contracts. And so in this example, what we're showing specifically is a left side order and a right side order. So the left side is the blue, The right side is the pinkish color. And so you could also think of that as bid and ask liquidity as well in this particular example. The arrow pointing in the middle with P, we could call that the market price. And so each one of these orders has a specific amount of liquidity. That liquidity is evenly distributed from the lower tick to the upper tick. Doesn't matter whether it's contracts or collateral, it's equally divided among the range. When the price traverses through your range order, you will start to acquire a position or close a position, depending on what asset you put in. We're going to go back into split or the range orders again in more detail, but before I do that, to kind of help understand how our system works, one of the things that we did that is going to be relatively different from a concentrated liquidity standpoint is we use something called split user accounting. And if you notice that we gave you an option of what asset to actually deposit into an order. It can either be the contracts or it can actually be the collateral. So in a nutshell, what we're trying to do with, or what split user accounting is we're trying to allow users to control their long and short exposure by defining the assets that they put into the range order. And so again, what we mentioned is the left side orders, you can kind of look at them as bid side orders. The right side orders can be considered ask side orders. We can deposit either collateral or options. Now, in a right side order, if we wanted to deposit collateral, what does that mean? Well, if we're depositing collateral on the right side, we want to establish or at least open a short position. That would be the first action that happens within this range order. Now, if our order completely traverses from left to right and we fill in our entire range, we will be short the maximum amount that we specified with our quantity. Now, at that point, you have a choice of whether or not you want to withdraw the short position or not. If you don't, and price traverses right back to its original point, you would actually just close your short position. So you wouldn't establish any sort of long position. It's just about opening your short or closing your short. Now, if you did the same range order, but this time you did it with option contracts, in this case specifically long option contracts, the two actions that you have, depending on the direction of traversal of your range order, is either to close the long or to get long again. And this is going to be very similar to the left side orders, but in the left side order is going to be just sort of the mirror image, right? So if we're depositing collateral, we want to actually get long options or close the longs. If we're depositing short contracts, we want to either close those shorts or reestablish and open a short. So now we'll kind of get more into the details of how this range order works. We're going to use an example here where we have a call option. We're going to be using ETH again. We'll assume that the call price, the ETH price is 1,500, and the current market price for the option is 0.35. And so in dollar terms, that'd be roughly around $525. This is going to be a left side order, or what we call bid liquidity. And the reason for this is because the market price is 0.35, and our range order is actually between 0.25 and 0.30. And so it's completely to the left of the current market price. Now in this particular example, we're going to deposit 1 ETH. So we are just depositing collateral. And so if you remember from the previous slide, what that means is we're looking to get long contracts. And if the price traverses back the other way, we're looking to sell those long contracts. But we will never get short. So we're using purpose 1 for this example, right? Our action is to deposit collateral. So as I mentioned, we're going to get long options. So we can kind of traverse through this range order. We're going to go from right to left. So imagining the price is at 0.35, which is our starting point. You can see that our collateral, which is in blue, is our initial deposit amount, which is 1 ETH. The long position that we have is 0, so we have not established any position yet. And so as price starts to go down, and let's say it's somewhere in the middle of our range, you notice that the call options start to increase, right? The amount that we acquire starts to go up as the amount of collateral starts to go down. First thing that should be apparent is it looks relatively linear, right? And so what that means is the execution of the contracts that you're buying happens in a linear fashion. And so if it's linear, the first thing you might notice is that then the execution price that I'm going to get for this order is actually the midpoint between my lower and upper tick. So in this case, if I fully fill in my order, I would have executed at an average price of 0.275. Right? And so now we can say that we assume that the market has fully gone down to 0.25 and our order is completely filled. So in this particular case, we'll have a little bit over 3.5 contracts and we'll have no collateral. And so at that point, you can make a conscious choice. Do you want to keep your order out there and try to collect more fees, like trading fees? Do you want to keep that position because you like that position? In that case, you'd want to withdraw the range order. That's essentially up to the user and how exactly or what strategies they're using and how they want to utilize the pools. Fees and gas costs. All right, so I think I just mentioned a second ago that LPs collect fees, right? They collect trading fees, and this is very common in AMM structures, and the takers pay the trading fee. And so one characteristic of range orders is that I can concentrate liquidity in areas in which the market is currently trading so I can maximize my fee collection. And that holds true for our pools as well. Of that fee, 50% goes to the LP and 50% of it will go to the protocol. The protocol further divides that up into other components of the protocol, such as staking and just general tokenomics as well, which is a different topic and out of scope for this presentation, but there's a lot of good content on that on our site, so please check that out. In terms of trading fee, trying to understand the cost of a trade as an example. So this is the equation, right? It's the max of 3% of the total premiums or 30 bips of the quantity amount. And so just to kind of put numbers to this, if I wanted to trade a put option and the premium on it was $100 and the quantity I wanted to trade was $5 or 5 units, the trading fee for this would actually be $15. And that would be split 50-50 between the maker and the protocol. So LPs, they don't pay a trading fee, but they will have to pay a gas fee to put an LP range order. And so as of right now, at the time of this presentation, that cost ranges around 10 to 20 cents to be able to put an order or to cancel, replace an existing range order. So expirations and withdrawals. There's no lockups for LPs. So if I put a range order, I could remove it at any time I want. The fees that are collected are actually separate than the range order itself. And so I can collect these fees at any point in time. I don't necessarily have to remove my liquidity from the marketplace to be able to claim these fees. There's no cost to exercising. So this is something that can be done. Additionally, well, there is a gas cost, but other than that, there is no fee to exercise an option. Now, the two sides are obviously exercise and settle. So if I own an option, I would be exercising it if it's in the money. And in that case, I would receive the intrinsic value of the option. If I was short the option, I would have to settle that position. And in that case, the collateral gets released, but it's net of the intrinsic value. For LPs specifically, LPs can actually be either long or short the options depending on how their range order ended up at expiration. And so when LPs settle, they will automatically either exercise or settle based on the position exposure they have. So just to recap, we discussed the pool architecture and the pool design, how they work, how they're initialized, their characteristics. We talked about range orders and parameters. What does a range order look like? What parameters do I have to use? What happens when I put my range order in the market and the market goes through my range order? We also touched on split user accounting. So again, split user accounting is this functionality that allows a user to be able to get long or short in asset, which is typically not the case in basic AMM structures. So if you made it this far, thank you. Thank you for listening to everything we had to tell you about Premia V3. There's definitely more content available on the blog. You can reach out to us on Discord or Twitter, and we will continue to put media and content on YouTube as well, so check us out there.